When it comes to investing in equity, you have often heard that long-term investing is important to get most out of your equity returns. But what difference does it really make to your investment returns? This recent study has actually calculated the number of critical months for a fund's outperformance. Without these months, the fund would have underperformed the benchmark or at best given inline returns with the benchmark. Here is what the study found. In the last 10 years, the top 10 outperforming funds needed just 14 months or 11.7% of all months to outperform their benchmarks. In other words, if an investor had missed any of these 14 months, he or she wouldn't have been able to outperform the benchmarks. Such critical months can come at any point in a fund's journey. However, data shows that nearly 50% of retail investments in equity funds have average holding period of less than 2 years. Here is another example. Canara Robeco Blue Chip Equity Fund was the best performing large cap fund in 2020. Its best months were in February and March. However, if an investor had exited from the fund in January or had invested in the fund in April, he or she would have missed out on the entire outperformance of the fund. Remember, stock markets are always going to be volatile. You can use systematic investment plans or SIPs to average down your purchasing cost as and when markets decline. Also, stick to equity funds only for your long-term goals. For your short to medium-term goals, you can stick to debt funds or hybrid funds, which tend to be less volatile. When it comes to equity funds, the volatility tends to be higher, but also the returns can be higher. The only caveat is remember to invest for the long term.